What happened this morning was something nobody saw coming. Not the banks, not the analysts, not the traders glued to their screens, and definitely not the COMEX operators who watched their systems freeze up. They were staring at an order so massive, so out of the blue, it sent an immediate shockwave across the entire global silver market. This wasn't just a big purchase. This wasn't simple speculation. This was a coordinated strike, a financial ambush, and the system didn't just react, it flinched. Now, what made this so terrifying wasn't just the price spike. Silver moves, it jumps, it dips. I mean, we see that all the time. But what happened today was completely different. A single, unidentified entity swept into the market with a purchase order that experts are now estimating at around $4.2 billion. And the way they did it? This was a move only a major government or a mega institutional giant could pull off. 1 minute, the order books looked stable and calm. The next, the liquidity just vanished. Dealers who have access to the deep market data said it looked like someone reached in and just pulled the floor out from under everyone. The silver price didn't jump because of good news or inflation fears or some retail buying frenzy. No, it went vertical for one reason. Someone with incredibly deep pockets, even deeper information, and a frightening level of precision decided that today was the day to make their move. And the most disturbing part is how this order was executed. It wasn't a normal buy. It wasn't a hedge. It was engineered. It was structured, controlled, and layered through offshore brokers, dark pools, and non-U. S routes specifically to avoid being detected right away. The moment the market algorithms finally flagged the anomaly, the phones started ringing. Banks were calling each other in a panic. Who placed that order? Did you see the flow? Is this China? Is it a Gulf sovereign fund? Every single possibility was scarier than the last. Because a hidden buyer accumulating physical silver on this kind of scale isn't just a financial event. It's a signal. It's a sign that something huge is shifting behind the curtain. And today, we all felt the curtain move. You could actually feel it in the bond market first. Yields started flickering. Volatility indexes spiked. The dollar index, which had been strong all week, suddenly hesitated as if the trading algorithms sensed something massive was about to hit. And then, the silver chart just went vertical. It was too clean, too sharp for a normal buyer. It looked like the entire move was pre-planned and executed with military precision without a moment's hesitation. This isn't how regular investors behave. This is how governments behave when they know something big is coming. And that number, $4.2 billion, it's not an accident. It's not a nice round number. It's a calculated figure. It's large enough to seriously disrupt the global supply of physical silver, but just small enough to avoid triggering immediate geopolitical alarms. But it's perfectly positioned to send shockwaves through the COMEX, the LBMA, and every single institution that's holding paper silver they can't actually deliver. You see, the silver market has a dirty little secret that nobody likes to talk about. The paper market, the futures, the contracts, the ETFs, all the promises of silver, is at least 200 times larger than the actual physical metal available for delivery on the entire planet. Everyone just pretends this is normal. Everyone pretends the system is stable and can last forever. But the truth is simple, and it's terrifying. The silver market only works as long as nobody asks for the real metal. Well, today, someone asked. And they didn't ask for a piece of paper or a future or an option. They demanded delivery of the physical bars. And not just a small amount, a massive amount. The timing makes this even more disturbing. Inventories of physical silver in the major vaults are already sitting at multi-year lows. At the same time, industrial demand for silver is at an all-time high. It's needed for solar panels, for AI hardware, for robotics, medical equipment, and EV batteries. We know China has been stockpiling silver for months, but they've been doing it very, very quietly. And now, out of absolutely nowhere, a mystery buyer steps in with a $4.2 billion order for physical metal. This is not a coincidence. This is a message. Traders in Hong Kong and Singapore were reporting unusual activity last night. They saw abnormal volumes moving through private banking desks, many of them connected to state-linked funds. Around the same time, mining companies started reporting delayed shipments and unexplained buying pressure. They've been getting private contract offers from buyers who refuse to identify themselves publicly. So why would you hide your identity when you're buying this much silver? The answer is simple. Because if the world knew who was buying, the price wouldn't just rise, it would explode. Banks are already panicking behind closed doors, not because the buyer is unknown, but because the buyer is likely known to them. It's just not confirmed. There are only a handful of players on Earth capable of moving billions of dollars into physical silver without even blinking. You're talking about China's state mining reserve, Saudi Arabia's sovereign wealth funds, a giant like BlackRock operating through dark pools, maybe even Russia's external trade entities or a consortium of Gulf state funds. Any one of those would be explosive news. But the fact that all of them are completely silent, that's the loudest clue of all. When a buyer wants to show off their power, they buy publicly. When they want to send a warning, they buy quietly. The very structure of this purchase reveals the intention. The order was spread across multiple time zones. It specifically targeted physical metal, not paper contracts. It completely bypassed the big ETF channels. It avoided U.S. custodian vaults and moved through Swiss intermediaries instead. And most importantly, it demanded that the metal be pulled off the market immediately. This is the part the mainstream news will never report on. When physical silver is taken off the market this quickly, the entire pricing mechanism starts to crack. The COMEX relies on a delicate fiction, this idea that paper silver represents real silver. But once too many people demand the real thing all at once, that fiction collapses. And when it does, the price doesn't climb in a nice, neat line. It jumps in violent, uncontrollable steps. That's what this hidden buyer triggered today. It was a warning shot, a fracture in the illusion, a stark reminder that the real physical silver shortage is far, far worse than the official charts show. Some analysts are saying this might be the beginning of the great unwind, the moment when the physical shortage becomes absolutely impossible to hide anymore. Others think it's preparation for a major geopolitical shock, maybe a currency shift, a sanctions event, a major supply disruption, or a strategic move to corner key industrial markets. But every single expert agrees on one thing, that $4.2 billion purchase was not random. It wasn't emotional. It wasn't an investment in the traditional sense. It was a strategic move, precise, calculated, and deliberate. And now the entire world is holding its breath, waiting to see what comes next. The shock from the $4.2 billion silver strike didn't stay confined to the metals market. It spread outward like a financial earthquake, hitting every sensitive corner of the global system. The deeper analysts dug into the order flow, the clearer it became. This wasn't just a big buy. It was the first visible sign of an unseen accumulation strategy that has been unfolding for months, maybe even longer, without any public detection. What happened wasn't the beginning, it was the reveal. Within hours, liquidity models all across Wall Street started flashing red warnings. The sudden vacuum in available silver wasn't natural, it was engineered. Engineered by someone who understood exactly how the supply chain works, and more importantly, where it's weakest. See, inventories at COMEX registered vaults have been thinning for over a year, quietly draining ounce by ounce while most of the financial world was obsessed with tech stocks and interest rate drama. But the people who truly understand silver, the industrial giants, the sovereign funds, the strategic planners, they watch those inventories like hawks. And now, someone has finally made their move. This hidden buyer didn't just buy silver, they removed it from the system. This is the one action the COMEX fears most. Because physical silver leaving the system isn't like cash changing hands. It is more like someone walking into a bank vault and starting to take out the support beams. The entire structure becomes unstable. The illusion of abundance evaporates. The leverage collapses under its own weight. Think about it. Banks rely on the idea that people will settle in cash instead of taking delivery. Miners rely on the assumption that demand will be predictable. Industrial users rely on steady supply, steady pricing, steady shipping. And investors, well, they rely on the trust that the system is bigger than any single player. But today proved that's not true. The system is only as strong as its weakest holder. And today's hidden buyer just found that weak point and pushed hard. Behind closed doors, a quiet panic is building. Banks that have been shorting silver for years, betting on its price to go down, suddenly realized they don't know whether this hidden buyer is friendly or hostile. If this buyer keeps draining supply, spreads will widen, delivery premiums will explode, and the paper market will become dangerously disconnected from physical reality. Some insiders are already whispering that this might be the start of a massive short squeeze, one far larger than anything we saw with GameStop. Except this time, the player isn't using memes, they're using billions of dollars. They don't want a short-term spike, they want structural leverage, they want control. Look closer at how this order behaved. You can map its fingerprints across global exchanges. During Asian hours, thin liquidity allowed for massive accumulation without raising alarms. During European hours, dark pool routing was used to disguise the institutional identity. And during US hours, they avoided COMEX price triggers by spreading the buys across multiple broker channels. This wasn't guesswork. This was a masterpiece of operational intelligence. Whoever executed this understands the deepest levels of the market: microstructure, delivery mechanisms, vault logistics, industrial demand cycles, sovereign reserve strategies, and even pricing algorithms. This is the stuff that only state-level strategists and top-tier hedge fund architects truly understand. The sophistication is too high for a random billionaire. It's too precise for retail investors. It's too silent for a Western institution. And it's way too aggressive for a standard metals ETF. Someone is preparing for something. And the panic deepened even further when analysts realized the timing lined up perfectly with a sudden, unexplained drop in reported Chinese silver exports. It's no secret China has been accumulating gold aggressively, but silver has been the real mystery for the last 2 years. We've seen unexplained withdrawals from Shanghai vaults, strange movements across bonded warehouses in Qingdao, and rising industrial consumption despite a slowing economy. And now, a $4.2 billion accumulation strike? At this scale, coincidence doesn't exist. Then there's the cargo data. Shipping intelligence sources have revealed a sharp increase in chartered cargoes labeled under industrial metals, bound for Asian and Middle Eastern ports. When these records were cross-referenced with customs filings, the declared tonnage didn't match the vessel capacities. That means only one thing: undeclared metal is moving offshore. Hidden flows, shadow logistics. But it gets worse. At the same time this is happening, tech giants are quietly filing urgent procurement orders for silver-heavy components. Solar manufacturers are doubling their demand projections. Electric vehicle companies are already warning about upcoming shortages, and AI server producers are quietly stocking up on key materials. In their world, silver isn't just a precious metal, it's a critical, irreplaceable component. Without it, factories stop. Technology stops, production stops. Everyone wants silver and no one is admitting it. But this hidden buyer, they just admitted it with their actions. When you remove billions of dollars worth of silver from the global supply in a single, coordinated move, you're not speculating, you're preparing. Preparing for what? That's the question Wall Street doesn't want to ask out loud. Maybe it's preparation for a major supply chain disruption. Maybe it's a hedge against an incoming currency event. Maybe someone knows that inflation is coming back stronger than anyone expects. Or perhaps a major geopolitical shift is about to shock the markets. Maybe the world is quietly moving toward a new metal-backed settlement system. Or maybe, just maybe, the buyer knows silver's real price should already be far higher, and they're just getting into position before the rest of the world catches up. You could feel the fear ripple through the futures market. Bid-ask spreads widened instantly. Options volatility spiked, even though the actual price movement was relatively small. That only happens when the market makers, the big players who provide liquidity, sense deep instability. They weren't protecting themselves against a price change, they were protecting against delivery risk. The worst fear of any metals market maker is the same. What if someone calls our bluff? The COMEX was never built to handle mass physical demand. If just one single major player asked for a fraction of the outstanding contracts to be delivered in real, physical metal, it would break the entire system. Today's buyer didn't just ask, they demanded. And that's why vault managers were completely silent all afternoon. Nobody wants to be the one to admit just how thin the physical inventory really is. And in back rooms from London to New York, emergency meetings were held. These always happen off the record when something like this occurs. Analysts are asked to project outcomes, strategists are told to calculate worst-case scenarios, and lawyers are called in to remind the banks exactly what they are legally obligated to deliver. In these moments, everyone becomes painfully aware that the silver market is one of the most fragile systems, still operating under an illusion of stability. Because when this hidden buyer moves again, and they will move again, everything changes. Industrial supply chains, strategic reserves, energy infrastructure, global manufacturing, and the entire monetary foundation that sits beneath the dollar itself. This was not just a buy, it was a crack in the foundation. It was a warning shot. A signal that the world's most undervalued metal has just been targeted by a player who understands exactly how rare, how essential, and how strategically important silver has truly become. And Wall Street knows the truth. If this buyer continues, the price won't just climb gradually, it will jump in violent, unstoppable leaps. The truth is starting to come out, but not fast enough for most people to grasp what's really happening. The silver market has always been small compared to gold or oil, but today it's acting like a market under siege. A hidden $4.2 billion buyer just showed up out of nowhere, and it's exposing every single weakness in the system. Even after the initial price shock started to settle down, analysts noticed something far more alarming. The futures curve began to invert. Now, this is incredibly rare. It means the price for immediate physical silver is rising faster than the price for future delivery. It is a classic sign that demand for metal, right now, is far stronger than anyone expects long term. This is called backwardation, and when it hits the silver market, it screams shortage. Over the past 25 years, deep backwardation has only ever appeared during moments of extreme panic. The 2008 financial crisis, the 2011 silver mania, and the 2020 liquidity crash. And now, it's back. But this time, the demand isn't coming from panicked retail traders. It's coming from someone coordinated, sophisticated, and with a very clear long-term plan. In the days after the spike, a few metals researchers started quietly tracking tonnage movements between vaults in Europe, Asia, and the Middle East. What they found didn't match up with any normal industrial or commercial flows. Bulk shipments were being redirected from Switzerland, straight to the UAE, completely bypassing the usual trading routes. Refiners in Turkey reported getting unusual requests for specific purity levels, not for coins or small bars, but for large industrial-grade slabs. These are typically bought by governments, aerospace contractors, and elite manufacturing firms. At the same time, Singapore's allocated vaults saw a sudden 23% jump in reservation requests, mostly from private, undisclosed accounts. These are the kinds of patterns you see when major players are bracing for a geopolitical or monetary shock. They don't buy paper ETFs. They don't buy mining stocks. They secure physical metal they can actually control. The next clue that the system is under extreme stress came from the derivatives market. Options volatility exploded to levels we haven't seen since the silver squeeze attempts back in 2021. Market makers immediately widened the spreads between buy and sell prices, they forced collateral requirements higher, and they started limiting leverage for retail accounts. This is what insiders do when they expect a destabilizing event. They didn't do this during normal market noise. They did it specifically after that mysterious $4.2 billion accumulation. Then came the slip-up. A bullion bank strategist, speaking in what he thought was a private briefing, said the spike originated from a source with clear knowledge of structural tightness. That one phrase, structural tightness, sent shockwaves through the room. It implies the buyer knew exactly how fragile the market was. They knew the perfect moment to strike, the precise liquidity gap to target, and the exact amount of money needed to trigger a systemic chain reaction. And that chain reaction is now accelerating. Behind closed doors, industrial manufacturers are panicking, especially in the solar sector. The world is trying to transition to renewable energy way faster than mining capacity can keep up. The average solar panel needs about 20 grams of silver, and the newer, more advanced models need even more. Now, multiply that by the billions of panels planned for the next decade, and you have a consumption curve that looks like a runaway freight train. If the silver supply tightens any further, solar expansion grinds to a halt, renewable energy targets will be missed, and governments will lose massive political capital. Corporations know this. Governments know this. And someone, very quietly, is positioning themselves for it. A $4.2 billion purchase isn't just speculation. It equals a strategic move to secure leverage over a resource that will power the entire next energy era. Meanwhile, U.S. refineries have started raising their premiums far above the international averages, which is a sure sign that domestic supply is draining faster than anyone expected. Wholesalers in California and Texas are quoting delivery delays of up to 11 weeks. Industrial users in the semiconductor and EV space are being forced into early contract renegotiations. Supply chain managers are privately warning that by the middle of this year, some manufacturers could face rationing. When a commodity gets to the rationing phase, prices are no longer set by market forces. They're dictated by pure scarcity. And scarcity is exactly what this hidden buyer is exploiting. The big question, of course, is why? Why would someone intentionally trigger a coordinated price spike at a time when the world is desperately trying to stabilize its metal supply? The most logical explanation is that they are preparing for a major monetary realignment. Inflation has destroyed purchasing power in every major currency. The U.S. national debt is now at levels that economists once swore were impossible without a systemic collapse. Central banks, especially in emerging markets, have been hoarding gold at record levels. But silver, which has been used as money for thousands of years, has lagged far behind, even as its available supply continues to shrink. If a major player believes a currency reset, a debt crisis, or a global liquidity shock is coming, then accumulating physical silver now, quietly, aggressively, and out of sight, is a strategic masterstroke. It's not just about making a profit, it's about securing control. This theory gained even more weight when analysts detected a sudden spike in offshore dollar hedging by major Asian financial institutions. Usually, when institutions hedge their dollar exposure, they diversify into a mix of assets: gold, treasuries, other commodities. But this time, the hedge was heavily skewed towards silver, as if they were expecting the metal to undergo a major revaluation. And the timing was perfect. It happened right before the hidden buyer's massive order hit the market. It's almost as if the hedging and the purchase were coordinated, two parts of the same structured plan. At the same time, Western banks have been desperately trying to keep a lid on the price by shorting the futures market. But their short exposure is now approaching critical levels. If this mystery buyer decides to stand for physical delivery on enough of their contracts, it could trigger a historic short squeeze. It would force these banks to buy back billions of dollars worth of contracts at any price they can find. That scenario would send silver skyrocketing in a matter of days, not months. We've seen it happen in other commodities. It nearly happened with nickel back in 2022. And silver, with its paper-thin supply, is an even easier target. This is why a deafening silence has fallen over the institutional world. No major bank wants to admit how vulnerable the system really is. No government wants to acknowledge that the industrial backbone of the global economy depends on a metal they simply cannot produce fast enough. And no analyst wants to be the first to publicly state the obvious, that the $4.2 billion buyer might not be finished. Because if this buyer shows up again, if even one more billion-dollar order hits this market, silver won't just rise, it will break. The price discovery mechanism itself will implode under the weight of physical demand and shortages. And the moment silver breaks, it sets off a domino effect across gold, copper, energy metals, and eventually the currencies themselves. This is why the smartest money in the world is watching the silver market right now. Because silver is the fuse. It always has been. And somewhere, out there in the shadows, the person or entity holding that $4.2 billion position knows exactly how close we are to ignition. Thanks for watching. If you found this valuable, make sure to like and subscribe for more deep dives into the forces moving our world.